Thank you, Agustin. Monetary policy has gone through a tumultuous journey since the beginning of the century. From the deceptive tranquility of the so-called Great Moderation to the agitated waters of the great financial crisis, a pandemic, and then a surprising surge in inflation. Policy settings have been on an equally extraordinary journey. Interest rates reach historical troughs, and central bank balance sheets historical peaks during the pandemic. And the subsequent inflation surge elicited one of the most intense and synchronized tightenings on record. Central banks have navigated these turbulent waters and delivered. They have contained the damage of financial crisis. They have avoided major shortfalls of inflation from target. And they are well on their way to reestablishing price stability. This has proved once more the value to society of having an independent institution devoted to that objective. At the same time, surely such an extraordinary journey holds lessons for monetary policy, for what it can and it cannot achieve, and for how it might be refined to face challenges ahead. In this year's annual economic report, we devote a chapter to these issues. We identify lessons and propose refinements. We draw 5 lessons which concern the ability to prevent transitions from low to high inflation regimes, the ability to stabilize the financial system during crises, the impact of prolonged and intense easing, communication, and the role of complementary tools such as foreign exchange intervention and macroprudential measures. The refinements concern how best to assure price and financial stability, and they rely on the importance of 5 considerations: robustness, realism in ambition, safety margins, nimbleness, and coherence across policy domains. So let me elaborate. To start with, recall the basic features of the tumultuous journey. As argued in detail in previous annual economic reports, the global financial crisis was in fact the most spectacular example of a subtle change in the nature of the business cycle that gradually has been taking shape since the beginning or since the mid-1980s. As we see in this graph, from downturns induced by a sharp monetary policy tightening to quell rising inflation, to downturns caused by a largely spontaneous unwinding of financial imbalances. The shift, in turn, reflected a combination of factors: central bank success in taming inflation, financial liberalization, and the globalization of the real side of the economy. The recession ushered in by the great financial crisis was especially deep and prolonged, testing policymakers to the full. As we see here, the blue line remains well below the red line. Central banks pulled out all the stops and embarked on an unprecedented phase of monetary easing, first to stabilize the financial system, then to nurture the recovery, and finally to push a stubbornly low inflation rate back to target. Policy rates reached new troughs, sometimes even negative in nominal terms, and central bank balance sheets soared to wartime peaks. The pandemic was a bolt from the blue, an exceptionally sharp contraction, global contraction, induced by a health emergency, as the economy was placed in suspended animation to quell the virus. Once again, central banks, alongside other policymakers, pulled out all the stops to stabilize the system and nurture it back to health. And once again, policy rates reached new troughs and balance sheets new heights. Then, as containment measures were lifted and economies rebounded, inflation surged, exacerbated by the war-induced sharp rising commodity prices. Once the inflation surge proved persistent, central banks tightened strongly around the world. And where are we now? Inflation is returning to target as central banks travel the last mile. In both nominal and real terms, interest rates are roughly where they were before the great financial crisis. And central bank balance sheets have begun to contract. Looking back at this tumultuous journey, at least 5 lessons stand out. Some confirm previous convictions, others nuance them, But they all shed light on the power and limitations of monetary policy. Lesson number 1. Forceful monetary policy tightening can forestall a shift to a high inflation regime. Now, to be sure, while other forces played a much bigger role, monetary policy did contribute to the inflation flare-up. Surely the exceptionally forceful and sustained easing accommodated it, as savings were run down and fiscal policy was loosened substantially. As this graph illustrates, there is a positive correlation across countries between inflation on the one hand and the degree of monetary policy easing, that's the left-hand panel, and fiscal expansion, that's the right-hand panel, on the other during this episode. Moreover, the initial hesitancy prolonged the accommodation. But central banks did prevent inflation from becoming entrenched. They responded more vigorously than they had in the 1970s, despite a similar initial increase in inflation. We see here that the solid blue line goes and stays higher than the red one. They restrained the expansion in nominal aggregate demand. We see here that the more cyclically sensitive prices responded most. The left-hand bar is much bigger than the right-hand one. And more importantly, they prevented an inflation psychology from setting in, as suggested by the stability of inflation expectations that Agustin stressed in his presentation. Lesson number 2. Forceful action can stabilize the system at times of financial crisis and prevent the economy from falling into a tailspin. By so doing, it also eliminates a major source of deflationary pressures. The experiences during the great financial crisis and the pandemic strongly support this old conviction. Now, during crisis, the deployment of central bank balance sheets does the heavy lifting, as the institution is called upon to act as lender and increasingly market maker of last resort in domestic or foreign currency. Indeed, the mere announcement of the measures can calm markets, be these for FX swaps, for corporate bonds, or for sovereign bonds in emerging market economies, as we see in these 3 panels. That said, the power of central banks has clear limits. Whenever the solvency of borrowers is threatened, this requires government backstops. And central bank interventions, if repeated, can encourage risk-taking in the longer term. Hence the importance of regulation and supervision. Lesson number 3. Strong and prolonged monetary easing faces limitations. Arguably, these limitations were not fully appreciated when central banks embarked on the post-GFC long accommodation phase. There are clear signs of diminishing returns. Large-scale asset purchases lose some of their power to push down yields once market stress wanes. We see that the red bar is much larger than the blue one. And the impact of interest rates on aggregate demand weakens once interest rates reach low levels and stay there. Here, the red line is much lower than the blue one. This is consistent with the difficulties many central banks faced when pushing inflation back to point targets following the GFC, even as the effects of the crisis faded. And it is also consistent with the broader evidence examined in detail in the 2022 Annual Economic Report and illustrated again in this graph, that monetary policy operates through a rather narrow set of cyclically sensitive sectors when inflation evolves in a low inflation regime. Even after 13 months, the percentage of sectors that display a statistically significant price response is only 20%. Monetary policy cannot fine-tune inflation under such circumstances. This in turn amplifies the by now familiar side effects of rates that stay low for long. One such side effect is a weakening in the profitability and hence resilience of financial intermediaries, be these banks, by sapping net interest margins, hence the positive correlation across countries between the level of interest rates and margins, shown in this panel, or insurance companies and pension funds, given that their liabilities have a longer duration than their assets. Another side effect is helping to keep in business structurally unprofitable firms, so-called zombies, worsening the allocation of capital. We see that their share grew during the low for long era. Yet another side effect concerns the economic and political economy challenges raised by large and risky central bank balance sheets, such as through the volatility of the financial results and their impact on government finances. And a more general one is encouraging restating and the buildup of financial vulnerabilities, which is one reason for the banking turmoil that we saw in March 2023. Lesson number 4, communication has become more complicated. For one, the multiplicity of instruments makes it hard to aggregate their effect and to understand which of them are intended to influence the stance and when. Partly as a result, markets may respond more unpredictably. Recall, for instance, the taper tantrum, when the mere announcement of a slowdown in future purchases by the Fed jolted markets around the world. In addition, the failure to anticipate the inflation surge, as shown in the large forecast errors in this panel, has threatened central banks' credibility. More generally, there is a growing expectations gap between what central banks are expected to deliver and what they can actually deliver. Just to cite one example, think of the pressure on central banks to explain their record concerning income and wealth inequality, reflected in the growing number of central bank speeches on the subject that we see here, and to which we devoted a whole chapter in the 2021 Annual Economic Report. Lesson number 5. Central banks can deploy complementary tools to help improve the near-term trade-offs that monetary policy faces between price and financial stability. These include, notably, FX intervention, but importantly, only if used judiciously and not as a substitute for necessary macroeconomic adjustments, and macro-prudential measures, a welcome addition to the prudential arsenal. As elaborated in the 2019 Annual Economic Report, the two tools work in similar ways to address financial imbalances, be these external or domestic. The tools strengthen resilience by accumulating buffers. Think of foreign exchange reserves or, say, stronger bank capital. And they help constrain the buildup of the imbalances in the first place. As an illustration, this graph shows their resilience-building function. In the left-hand panel, we see that larger FX buffers limit depreciations following shocks. The red bar is larger than the blue one. And in the right-hand panel, we see that tightening macroprudential measures reduces the probability of banking stress, regardless of whether this is done before or after the first interest rate hike. The two bars are roughly equal in size. This underscores the complementarity with monetary policy. What possible refinements to current frameworks do these lessons suggest? Considering refinements is important, since the years ahead may be no less challenging. Unless fiscal positions are brought under control, the threats to financial and macroeconomic stability can only grow. In addition, the risk of global fragmentation, the reality of climate change, and the demographic trends underway could make the supply of goods and services less elastic and more shock-prone, and the world more inflation-prone as a result. At the same time, a return of persistent disinflationary pressures cannot be ruled out altogether, especially if the current broad wave of technological advances bears fruit. As the chapter elaborates, 5 considerations could inform the refinements: robustness, realism in ambition, safety margins, nimbleness, and coherence across policy domains. Together, the refinements can reduce the risk that monetary policy, just as fiscal policy, is relied upon excessively to drive growth, the growth illusion discussed in detail in last year's Annual Economic Report. And they are designed to ensure that monetary policy focuses on price stability while at the same time safeguarding financial stability. Now, considering in turn the implications of the guiding considerations for the operational definition of price stability, for acceptable deviations from targets, for the deployment of tools, and for communication strategies and institutional arrangements. The operational definition of price stability would need to help hardwire a low inflation regime while allowing for deviations that are consistent with the ability of central banks to control inflation. Ideally, the objective would be low enough so that inflation did not materially influence economic agents' behavior. Indeed, adjusting current targets upwards, quite apart from risking to undermine central banks' hard-earned credibility, would not be consistent with this goal and would risk squandering the self-equilibrating properties that inflation exhibits in a low inflation regime. The acceptable deviations from targets would need to take into account the specific features of inflation across low and high inflation regimes. Once inflation evolves in a low inflation regime, there is room for greater tolerance than in the past for moderate, even if persistent shortfalls of inflation from narrowly defined targets. The additional room would take advantage of the self-equilibrating properties of inflation in a low inflation regime and reduce the side effects of keeping interest rates very low for long. This would allow central banks to better take into account the threats to financial, macroeconomic, and price stability that develop over longer horizons and would lower the risk of losing precious safety margins. By contrast, when inflation threatens to shift from a low to a high inflation regime, there is a need to react strongly owing to the self-reinforcing features of those transitions. It is one thing to avoid fine-tuning, it is quite another to put the system's self-equilibrating properties to the test. The deployment of tools would need to stress prudence, especially given the importance of safety margins in reducing the vulnerability of the economy. This means implementing policies that include, as an explicit consideration, retaining policy room for maneuver over successive business and financial cycles. It means putting a premium on exit strategies from extreme policy settings designed to stabilize the economy, and on keeping balance sheets as small and as riskless as possible, subject to effectively fulfilling mandates. And it means avoiding over-reliance on approaches that may unduly hinder flexibility, such as certain forms of forward guidance, critical dependencies on unobservable and highly model-specific concepts, such as R*, or frameworks designed for seemingly invariant economic environments. Communication strategies and institutional arrangements would need to be tailored to a perennial condition of monetary policy, the need to take actions that involve costs in the short run to reap bigger benefits in the longer run, a root cause of short-termism. As for communication, the toughest and growing challenge is to narrow the expectations gap, a major source of pressure on central banks to test the limits of sustainable economic expansions and to pursue mutually inconsistent and overly ambitious objectives. Failing to address this gap can ultimately undermine the central bank's legitimacy and society's trust. As for institutional arrangements, there is a need to shield the central bank from political economy pressures, be these links to inflation or to the buildup of financial imbalances. Safeguards for central bank independence are essential. They may become even more important in the years ahead as pressures on fiscal positions grow. This brings me to the broader importance of coherence across policy domains. Coherence is important to ease the trade-offs that monetary policy faces when fulfilling its mandate. Coherence can be achieved through a more holistic macro-financial stability framework in which fiscal policy remains proportionate and sustainable, operating just as monetary policy with adequate safety margins. Prudential policy, both micro and macroprudential, continues to strengthen the financial system, and structural policies lift sustainable growth. It is such coherence that holds the key to lasting macroeconomic and financial stability. Thank you, and now let me turn to Hume.